Welcome to The Explainer. Today, we're going to pull back the curtain on how some of the sharpest real estate investors always seem to close deals while everyone else is still stuck waiting on the bank. We are talking about the hard money loan, what I like to call the investor's speed pass.
It's a question that drives a lot of people in real estate absolutely crazy. You spot that perfect property, it's a great deal, but by the time you can get all your financial ducks in a row, poof, it's gone. The answer, more often than not, comes down to one simple thing: speed. So let's dive right into the heart of the problem. You got to understand, from the moment a great property hits the market, a race begins. And there's this fundamental mismatch in this race that leaves so many would-be investors in the dust. Okay, so picture this. On one side, you've got the slow path, traditional bank loans. We all know them. They are notoriously slow, right? We're talking 30, 60, sometimes even more days, because they're digging into every single corner of your personal finances. But on the other side, you have the fast lane, the actual market, where the best deals, the real gems, get snapped up in a matter of days. That gap between the slow loan and the fast market, that's where opportunities go to die. So how do the pros beat the clock every single time? Well, they don't even get on that slow, winding path to begin with. They pull out an investor's secret weapon, a financial tool built for one purpose and one purpose only: speed. So what is this thing? A hard money loan. At its core, it's all about the asset. Forget about those mountains of paperwork, your W-2s, your tax returns. The lender's main question isn't about you, it's about the hard asset, the property itself. And you know what? That one little shift changes absolutely everything. And what's so cool about this is how it completely flips the script. See, instead of a traditional bank asking, hey, can this person pay us back? The hard money lender is asking a totally different question. Is this property a good enough investment to cover our loan? That focus, right there on the asset, that's what unlocks the incredible speed and flexibility that investors absolutely need to compete. But look, this is not a one-size-fits-all kind of deal. You should think of it more like a financial multi-tool, you know? It's got a specific attachment that's perfectly designed for almost any kind of project an investor could possibly dream up. So first up, you've got your classic fix and flip. For an investor who finds that diamond in the rough, that distressed property that just needs a little love, time is literally money. This loan gives them the cash to buy the house and start swinging hammers immediately so they can get it fixed up and back on the market fast. Then, what about someone who's building a rental portfolio? For them, there's the DSCR loan. That stands for Debt Service Coverage Ratio, and honestly, it's brilliant. It qualifies you based on whether the property can generate enough rent to cover its own mortgage. Your personal income? It's not the star of the show anymore. Okay, but what if you're not just fixing a house? What if you're building one from scratch? Well, that's where ground-up construction loans come in. They're designed to fund the project in stages that actually make sense with the construction timeline, from buying that empty plot of land all the way to putting on the final coat of paint. And this one really shows you the power of timing. It's called a bridge loan because that's exactly what it does. It builds a financial bridge. Let's say you find the perfect new investment property, but you haven't sold your old one yet. This loan bridges that gap in funding so you don't miss out on that new opportunity. And the toolkit just keeps getting bigger. There's specialized financing for larger investments like apartment buildings, and there are even solutions for self-employed investors. Bank statement loans let you qualify using your business's actual cash flow, the deposits going into your account, instead of traditional tax returns. It's a real game changer. Okay, so all these options sound amazing, right? But are they really as simple and fast as they claim to be? Let's take a look at what the process actually involves. So the paperwork needed it's incredibly streamlined compared to a traditional mortgage. For most deals, it really just boils down to the application, a couple of recent bank statements, your ID, and your company documents if you're buying through an LLC or something. And that's it. It just cuts right through all that red tape.
Now, here's a really important point. There are no upfront application fees or processing fees that you have to pay to the lender. The only thing you might pay for upfront is a standard third-party appraisal to confirm the property's value, which, is pretty normal for any real estate loan. It just lowers the barrier to get things moving.
And here it is, the number that changes the entire game. The whole process, from the day you apply to the day you get your money, averages just 14 days. 14. Compare that to 30, 60, even 90 days with a traditional bank. In a hot market, that difference isn't just an advantage, it's everything.
All right, let's put all these pieces together and look at the side-by-side comparison, because for an investor, this is really what it all comes down to.
I mean, this table just lays it all out, crystal clear. The approval time is a night and day difference. The main requirement shifts from being all about you to being all about the property. And it shows you that while a traditional loan is perfect for buying the home you're going to live in, a hard money loan is a specialized high-performance tool built for the fast-paced world of real estate investing.
So, what's the key takeaway here? It's that a hard money loan isn't just another way to borrow money. It's a strategic advantage. It gives you the speed to jump on deals before anyone else, the flexibility to fund all kinds of different projects, and it opens up a path to financing based on the quality of the deal itself. So, we'll leave you with this final thought to chew on. When you're an investor, the interest rate you pay on a loan, well, that's a known cost. You can put it in a spreadsheet. But the cost of a missed opportunity, the one that got away, well, that's a number you can never truly calculate.